Hey everyone, welcome to another video on the channel. Today we're going to be taking another look at ZIM, Integrated Shipping Services, also known by the ticker symbol ZIM, Z-I-M. So, since the last we talked about ZIM, the stock price has continued to decline. But why is this, and can we expect any future upside? Personally, I'm not a financial advisor, but I think it's totally unreasonable the extent to which ZIM has just been beaten down over the past weeks, especially, and months more broadly. I think the company still has a lot of positives going for it. I think the market has been way too harsh on it. But let's get into it. First and foremost, just looking at the chart. So we could see this is the past 6 months, and it's an ugly chart. I mean, there's no way around it. We had that massive upside swing where the stock went all the way to $90, and then we've just been trading lower since, and now we're all the way down to the low 30s, so it's been quite a decline. But as we'll see, I think the stock still has its perks. And I think the most obvious perk, as most ZIM shareholders or even stock watchers are aware, is the fact that it has an immense dividend and tons of cash flow. I mean, keep this in mind. This absolutely blows my mind when I think about this. The price to earning ratio on ZIM right now, it's 0.64. I mean, think about that. I had done a video some weeks ago. At that point, the PE ratio was a PE ratio of 1, which at the time we had said that's super low, even compared to its other competitors, other shippers who are trading around still low PEs, but around 2.5 or 3. It was trading at 1, and now it's trading at 0.64. I mean, come on, it's just unfair. It doesn't make sense. It's unfair that it was hammered down so low, but it is what it is. And this I thought was interesting, just comparing ZIM to some of its competitors. So their average revenue per TEU, which again, TEU is a unit of measure in the container shipping industry that specifies how much they're utilizing their space or whatnot. So their revenue per TEU is way higher than any of its competitors. I mean, just looking at this chart, you don't even have to look at the prior quarters, but if you do, you can see its TEU ratio, revenue is increasing steadily. But then starting the last quarter, it just shot ahead of all of its competitors, and it's still ahead of all of its competitors. So the revenue generating capacity on ZIM has never been stronger, literally never been stronger, despite the price drop. But again, we're in the situation we are. And how is the company doing with cash flow currently? Well, ZIM ended the last quarter with $946.8 million in cash, which that sounds pretty good. And as it says here, if lease liabilities are ignored and the bank deposits included, then $3.9 billion net cash position represents more than 90% of the current market cap. I mean, let that sink in for a second. The company is just awash in cash. I mean, and here you can see the earnings growth and low leverage ratio over here. Just, it's blowing it out of the park. It generated so much cash in the quarter that even after paying out $2.4 billion in dividends and investing in the future, it still has $743 million in cash that it could use now to pay down its debt. So, I mean, the company is in a very strong cash position. And in the last quarter, I know if you hadn't seen it, you could go back. I did a video when they released their quarterly earnings results, but they reiterated their full year guidance, which called for up to $6.7 billion in EBIT. So, I mean, the company's crushing it. It's awash in cash. So why is the stock price so battered? Well, if few things to keep in mind. I think this is very important. How there's been a divergence now between container spot rates and contract rates. As we know, ZIM is a company that benefits greatly from high spot rates, and those rates have not been as high. And so ZIM is, of course, not as profitable as it was. That being said, I'm going to bring this up again as well. I had done this in a past video, but I think it's a useful metric. So this is the Freightos Baltic Index, the Global Container Freight Index. Why am I bringing this up? Because it follows very closely with the stock price of ZIM. And as we've seen, so we had this massive run-up all the way up to like 11 grand or so. Yeah, it exceeded 11 grand at the end of 2021. Starting in around the end of February, early March, we've just been on this crazy decline, which now has declined about, it's been cut basically 50% in half to now it's about $5,000. So ZIM being so closely correlated to these rates, yeah, I mean, it makes sense that there would be some decline. Does it make sense that it would have the decline that it's had so far? I don't really think so, but the market is what the market is, so that's just kind of the way that it is. But I also wanted to talk about, yeah, so here we go. ZIM down 51% despite the bumper profits. I thought this was useful to take a look at. So some of it's kind of reiterating what we already said. But so ZIM estimated that its revenue for 2022 would be similar than last year when it had like a record-breaking year, and that annual EBITDA would grow from 6.6 billion in 2021 to 7.1 to 7.5 billion in 2022. The guidance was later raised to 7.8 to 8.2. I mean, they are not concerned about losing, revenue. They see increasing revenue. The results that ZIM had reported for the last 4 quarters, from the third quarter of 2021 to the second quarter of this year, are astonishing. EBITDA of 9.1 billion and a cumulative net profit of 6.2 billion. I mean, we're not talking small amounts here. So for the second quarter of the year, ZIM posted a net profit of 1.3 billion, 50% higher than in the corresponding quarter of 2021. I mean, 50% growth and the stock is crushed, really? I mean, 50% growth. We're talking like Tesla growth numbers here. I mean, we're not talking, tiny amounts of growth. But so all of that seems quite beneficial. And I also want to take a look at what the CEO, Eli Glickman, said, because I think he has a good longer-term perspective. And he says over here, when COVID started in 2020, there was this phenomenal rise in shipping prices, which, again, we saw when COVID started in 2020. Here we are in 2020. You can look on that chart, and that's when this massive increase really began. So, okay, that happened. So yeah, because of all the airports were shut, the ports were shut. There were all these supply chain issues, etc., as we know. And he says the cost of shipping by container, which was 2,000, reached a peak of 11,000 6 months ago. Again, that's that chart I just showed you where it went all the way up to 11,000, and now it's trading back to around 5,000. And he says the global shortage of freight capacity filtered through into the inflation because a rise in shipping costs affects the cost of import, and that was passed on to the consumer. Fine. So he's saying the combination of all these things led to a decline in shipping prices. They're still much higher than they were before COVID-19. But from 11,000, they've now fallen to around 5,000, so they are less than 50% of their peak. But as he continues to say, there's always these fluctuations. I mean, those 11,000 prices, as he says, I don't think there's a warning sign to the industry. At 11,000 a container, it's clear to everyone that this was an exceptional price level that would not be permanent. And he's sure that the company's planned accordingly. He's planning accordingly. I mean, they know that. They know that when it was at 11,000, this is a great time to make as much money as possible. But it's not going to stay. But guess what? I mean, even at 5,000, it's still like almost 5x from what it was in 2019, 2018, 2017. I mean, however long back, however far you want to go, it's still highly elevated. And so the company is still highly profitable, even if Wall Street right now wants nothing to do with it. So as far as I'm concerned, again, this is a stock that has really solid fundamentals. It has a great cash position. It has a great revenue position. Wall Street wants nothing to do with it. That's, just the way it is. But I still, again, I mean, the stock's paying crazy dividends. It has a great outlook. But let me know what you think. I've enough of my rant for today. Are you holding on to ZIM? Are you buying more? Are you using this dip that the stock has been experiencing for the past couple weeks as an opportunity to load up on shares? Have you had enough of ZIM? Are you selling? Let me know what you're doing with your shares in the comments section, and I'll catch you in the next one.